Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. We want to thank you so much for joining us and welcome you into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. Myself, my name is Chris Swan. 419-794-3030 is the phone number. That's 419-794-3030. The website, arhq.com. Today on the show, why the founder of the 401k is very concerned about fees. Are you kicking the long-term care can down the road? We'll talk about how you can plan for it, and we'll explain what the earnings test means for your Social Security, all this and more. But before we jump in, let me check in. Nolan, glad to be with you as always. How you doing, sir?
Doing wonderful. Just, again, continuing to enjoy some beautiful weather that we have here and travel a little bit this week. This past week, we had a couple of different Medicare events up in Ann Arbor for our Ann Arbor team. Then we had a couple here in Toledo. So kind of getting into the full swing with a lot of different events that are going on. We've got our economic summit that's going to be coming up. It is on October 2nd over at the Hilton Garden Inn, going to give our State of the Union address, talking about the market recaps and how to get prepared to go through the election time frame. We also have an event coming up in a couple of weeks over at Mancy's Italian Grill, where we're going to be talking about the 5 threats and opportunities facing retirees. So a lot of different educational events we'd love to have you, our listener, out to. If you haven't been to one, just go online, arhq.com, click on the events tab, and always love to meet our listeners, you know.
Absolutely. You know, again, if you've got the time to continue that education beyond here on the show, sit down with them in person at these events. You can go on arhq.com, click on the events tab there to find more information, including how to reserve your seat. If you can't make one of those and you want to just skip the line, get right in front of them, well, you're there on the website as well. Or like I said, give a call, 419-794-3030. So let's kick the show off talking about taxes. In 2017, Congress changed the tax laws with the so-called Trump tax cuts, and many of us don't itemize anymore. When those tax laws expire in 2026 at the end, December 31st of 2025, that might change for you. You might go back to itemizing. Here's wealth advisor Judy Brown on Yahoo Finance.
The one that's going to really affect most people, are all the tax brackets shifting. Like the top tax rate is going to go from 37 to 39.6%. The standard deduction is going to go in half. So people that weren't itemizing might be now. So that's when we're going to really see a lot of tax planning that will be very valuable.
Now, when you get into retirement, you may have more medical bills, and suddenly you can itemize for the first time in years, which is just one example of how taxes could be different in the future, especially when it comes to retirement. So how do you guys help people plan for taxes when it comes to retirement?
It's absolutely something that's important. And I think, even this example with the tax law set to expire in 2026, it's a lot that could change, after the election. I know that they have talked on both sides about their opinion with tax law changes. And, I guess the opinion when leading up to the election and post-election are two different things. But, when we look at it, we put together what's called the Retirement Team Action Plan. And the team stands for taxes, estate planning, asset protection, and money management. And it's always important, I think, to talk with your accountant or CPA when you're looking at making tax advice and making decisions on changes to your investments in your portfolio. But it's something that we love to work kind of hand in hand with the folks that we service and helping them in that holistic approach and taking taxes into consideration, running the numbers past a CPA or accountant and making sure that everybody's on the same page. I think regardless of who wins the election, one thing that we can agree is we have a massive tax problem and debt problem that we're going to have to deal with in the future. And it's fair to say that if history is a guideline, it would say that tax rates could be a lot higher for everybody. But in retirement time, taxes are different in retirement than when it's been in your working years. And a couple of things that jump out to me is, number one is the impact on healthcare costs pre-65, and then also Medicare cost premiums post-65. Two perfect examples. I'm working with this couple, John and Mary. John's going to be turning 65 and retiring at the end of this year. Mary is 62, so she's got a couple of years until she gets to Medicare age. They have an income goal of $6,000 to $7,000 a month, considering, where to take money out of their accounts and how to, fund their income goals, things like when to turn on Social Security. And all of those things are going to have a big impact, more specifically in this case, in Mary's situation, because the income that you have, that's your taxable income levels from 62 to 65, if you're on the Affordable Health Care Act, can have a big impact on, how much you pay for health care based upon what you report in taxes. And if you report the wrong number when you go to file your taxes, they could ask for that credit back, ultimately getting in a situation where, thousands and thousands or tens of thousands of dollars back if you got a healthcare premium and your income was too high. For people that are over 65, one of the questions that oftentimes comes up is things like paying off a mortgage. And, I would say conceptually, I agree with that concept. I think being debt-free in retirement is a good idea. But again, the income that you take out of retirement accounts is going to be reportable for what your Medicare premiums are. So if you're not careful what you do with your income levels, your Medicare premium can go up and double in price as well. The second thing that taxes are different is taxes on Social Security benefits. The question is, take money now or take money later. In John and Mary's situation, their original plan was they were going to start taking Social Security right away at retirement time. When John retired at the end of this year, again being 65, Mary's 62. Part of the problem with doing that is by taking Social Security benefits early, it's countable for that impact on healthcare costs, but two, they're then taking a lifetime reduction of benefits. And by running a Social Security optimization report, at least getting John to his full retirement age can be something that's beneficial. In fact, he could delay taking Social Security to age 70. I'm not sure if they want to do that or if that's their best approach, but taking it later means more income. The other advantage of that is the income that you get from Social Security currently is only up to 85% countable or taxable income. Where when you take withdrawals from a traditional retirement account like an IRA or 401k, it is usually 100% taxable. So again, Social Security can be more tax efficient in the long run than just standard withdrawals from a retirement account. So then you're looking at, which investment account to pull from. Do you take from the taxable account, tax deferred, tax free? And there's no one right or wrong answer for everybody. Again, using John and Mary's situation, to keep their healthcare costs affordable, they want to, withdraw a certain amount of money from their tax deferred accounts. They don't want their income to go too low because then they fall into what's called Medicaid type status. But they want their income to be low enough that they can get some of the premium tax credits for the healthcare costs to keep it low. So they might, want to use some of the money that they have from their taxable account. And then the last category is, looking at, when do you pull money from tax-free accounts? So looking at those Roth IRAs or looking at when to take money from those accounts to be the other situation. And it's kind of one of those moving parts on figuring out which accounts to pull from. And the impact of what you do and how you pull that out can have an impact on, again, taxation of Social Security. It's going to have an impact on your health insurance cost. It can have, an impact on how much money you leave for a legacy, which assets are better to leave in a legacy and which assets do you pull from, different. The number 4 is talking about the issue of possible tax rates in the future. And we're in a situation where we're spending money faster than we've ever spent. We've accumulated this national debt, and we have this massive amount of unfunded liabilities with things like Social Security, Medicare. And at the end of the day, it's one of those issues that they keep kicking the can down the curb. But at some point, somebody's going to have to pay for this. My opinion is if you look at your retirement account, it's usually your biggest or your second biggest asset that you own. And tax deferred means that you could end up paying higher taxes in the future. So when you're looking at taxes today, things like Roth conversions and considering maybe where you're at strategically or tactically in your, tax brackets can make sense to try to hedge against the possibility of higher taxes. I think society has taught an overwhelming majority of people that, hey, save and invest for the future because your tax rates will be lower. And that may not very well be true, especially, for folks who did save. Number 5 is the issue of required minimum distributions. Again, dependent upon what age you're born, but in general, people that are age 73 or higher need to take out required minimum distributions. And even though they may not need that money, that's going to be taxable income if they have that money come out to them. There again, if they're philanthropic, maybe they donate to their church or they have a charitable organization that's important to them, there could be some strategies to help minimize taxes based upon what they do with those required minimum distributions. And even thinking about it from a legacy standpoint, if charity is important to somebody, which assets you leave to charity versus which assets you leave to kids will have an impact on taxes in retirement. And then the 6th issue is capital gains taxes. So again, in John and Mary's situation, they have about $75,000 left on their mortgage. And looking at their overall monthly payment, it was about $2,000 a month. And they asked the question of, should we pay off our mortgage between some of our savings and outside investments? And does that make sense? And they're kind of weighing the fact that their outside investments have been performing well. The market's done good. And understanding to know that if you took those non-retirement accounts, you sold those assets and you had a gain, that gain would be a capital gain tax that they'd have on that. So navigating how do I pay and plan for taxes in retirement, it comes down to creating a tax roadmap. Overwhelming majority of the time, people will go to their CPA, go to the accountant, or log into TurboTax, and they'll do what I say is recording history, right? They'll put in all of their 1099s, they'll put in their tax forms, and it'll spit out the results. And, whether they owe money or whether they get a refund oftentimes depends upon how they feel, right? I feel good because I got a refund. Well, if you had some strategies in place and you could significantly reduce your tax liability not only this year but also in the future, that's really what proactive tax planning looks like when you're looking at these type of strategies in retirement time. And developing a plan, and again, the retirement team action plan, it means that we can create a team action plan. And in that team action plan, we can go through the tax savers checklist, look at 25 different items. We can create a tax roadmap for you that shows you what things look like today versus sometime in the future. Again, luckily in John and Mary's situation, he came in to see us, and as the date of this recording here in September, he has some time before he retires at the end of this year. And there may be strategies, they're most likely strategies that we're going to implement before the end of the year to help with his tax planning, specifically in Mary's situation to keep their health insurance cost affordable. But he has to kind of make those moves this year, because if he makes those moves next year, it'll show up on his 2025 taxes, which could impact his health insurance costs. So look, I get it, folks. Taxes are a confusing topic. If you're frustrated about taxes, or if you're just not sure, are there things that you could do to lower your taxes? We'd love to talk to you. We'd love to make some referrals if you don't have a good CPA or accountant, or more importantly, work with your CPA or accountant to develop a plan that's best for you in creating that retirement team action plan. So if you have more than $250,000 of retirement assets, give us a call. We'd be happy to put that together for you and help you plan for taxes in retirement.
It's a major difference between looking in the rearview mirror and how much you owe for the previous year, and then looking through the windshield and seeing how much, what is coming down the line and how to mitigate that. There's a difference between knowing that taxes are different in retirement, knowing how they could potentially be different in retirement, and how they will be different for you and how to go about planning for that. A great start, this retirement team action plan, including that tax roadmap. If you've got $250,000 or more in investable assets, give a call. Complimentary retirement team action plan, 419-794-3030. Or you can visit the website as well, and that is at arhq.com. There's a new list from Wallet Hub of the top 10 places to retire. It's based on cost of living, tax laws, quality of life, retirement activities, healthcare quality. Orlando is ranked number 1. Fort Lauderdale, Tampa, and Miami also making the top 10. A lot of retirees in Florida. Kind of makes sense. The thing is, relocation is out of the question for a lot of people because they want to remain close to family or, live in a paid off house. So how can you help maximize their retirement savings and strategies right where they live?
That's a great question. If you look at the top 10 places to retire, you've got four of them down in Florida. So Orlando, Fort Lauderdale, Tampa, and Miami. And I was just in Fort Lauderdale, and I was just in the Tampa area here recently. We were doing some college tours for my youngest son. He's looking at Florida Atlantic University. He's also looking at South Florida. So great locations. And I totally get it why people would want to live in those top 10 places. So when you're looking at the issue of maximizing your retirement strategy in your location, I think a lot of it comes down to one is, considering how to optimize your Social Security benefits.
Mm-hmm.
So when people are getting close to retirement time, they're looking at maybe a change of location. Florida is attractive for not only the beaches and the sunshine, no state income taxes, a lot of benefits down there, which make it in the top of the list. And so people will oftentimes probably start Social Security right when they retire. I think the statistic that's out there that I saw is roughly 70% of people will take Social Security before their full retirement age, but that might not be a way to maximize their retirement savings and strategies. If they want to get more income, it may be better off than to wait to optimize the strategies, wait to take Social Security later in life. And if you're going to move to a different location, maybe what that means is that you don't move right away. Maybe you rent out an Airbnb in a couple different places. Heck, if there's 4 top locations in Florida and Florida's on your list, maybe you do a couple different Airbnbs over the next 2 or 3 years, allowing you not to have that added expense of a Florida property, but allowing you to get a taste of the town, if you will. Because number 2, what you want to do is you want to be careful in retirement time to stay out of debt. Mm-hmm. I can tell you personally, having an office in West Palm and traveling down to Florida, we go to that Fort Lauderdale, West Palm area quite a bit. And if you look at the housing costs in that area or, almost in anywhere compared to Northwest Ohio, we have really affordable housing here in Northwest Ohio. I paid off my mortgage when my first son went to college a couple of years ago. He's now graduated college. And I think if I look at my retired clients that are out enjoying life and living the retirement dream, a general trend of them is that they don't have debt. So you want to be careful about location and going into a location at retirement time and taking on, a massive mortgage or debt payment would be number 2. Number 3 is minimizing taxes. This can be, again, another area where, those states that income taxes are not taxable make it attractive. Like Florida is a good example of that. But in the big scheme of things, you want to then work that into your taxation reduction plan for what you pay in federal taxes, because that can be the bigger number of the two when you're looking at the difference between federal and state. So in retirement, you could be debt free. And I oftentimes would then say, you know what, actually, you still have a big debt right now in retirement. And that debt is the taxes that the government feels is their fair share on taking from your retirement account when you take those withdrawals out. And looking at taxes today, looking at strategies to reduce taxes like the tax savers checklist, like creating that tax roadmap, and or thinking about where taxes will be in the future, minimizing the amount of taxes that you pay is going to allow you to have more money in your pocket. If you had to pay 25% in taxes, think about how long it takes before your money earns 20 or 25%. And that tax bite can chomp a lot into your retirement savings and strategies that you take. Number 4 is, again, going back to kind of understanding that cost of living based upon, where you're going to live. The cost of living and housing can be much more expensive in Florida, again, depending upon how close, I guess, you get to the beach and what location that you live in. But even the surrounding activities, Orlando is a perfect, travel destination where they, cater to, spending more money at some of these other locations. And not to say that you shouldn't dine out and have a good time in retirement time, but you have to compare what some of those costs are. You have to shop around. I think one of my wife and I's favorite things to do is find the little local hangouts and avoid some of the more expensive
Oh yeah.
attractions, and those are great because you get something that's off the beaten path. Usually get a little great music. We found a fish restaurant in the Fort Lauderdale area that we oftentimes will like to go to. Just again, understanding how you have to navigate where you live in that environment. Number 5 is you want to make sure that you're optimizing your investments. And when you're optimizing your investments, you're making sure that every dollar is working as hard as possible. At the same time, understanding, what the level of risk is. So if you're going to, take on bigger expenses or have a higher standard of living based upon the location, you want to see what would be the impact of a major market downturn. And then what are the strategies that you can take to reduce that? In retirement, I would say almost all roads lead to income. So looking at your income sources, looking at ways, not only through Social Security, but looking at things like, dividend paying stocks or looking at where some of these high fixed rates are, can be a way to optimize the overall investments. And number 6 is to have a plan and then stress test that plan. So when somebody comes in and they see us and we put together this retirement team action plan, inside of the retirement team action plan, what we're going to do is we're going to run roughly 2,000 possible scenarios of what could be the outcome if something happens in life. In an earlier segment, we were talking about a couple that recently came in, John and Mary. John's getting ready to retire at the end of the year. And when we looked at his plan and we looked at the overall basic scenarios, he had about 84% probability of success of meeting his retirement income goals when we stress test the plan. So in starting at taking a look at that, the thing that I would say is, to me, that's a pretty good start. I think when we do optimization of a plan, our goal is to get it over 90%. So he doesn't have a far to go once to get that probability of success as high as possible. But by doing that and stress testing the plan, what we were able to do is we were able to then, start to identify, okay, what could be the things that could blow up this plan? And in their situation, in John's situation, what we did is we added in the scenario of John needing assisted living for the last 2 years of his life. And, in today's dollars, that's maybe $55,000 a year. So again, it was assisted living. It wasn't the full-fledged cost of a nursing home. But if John ends up going into needing some assisted living for the last 2 years of his life or in-home care, what it did is it took his probability of success from that high 80 all the way down to about a 40% probability.
Oh.
So by going through the plan, what we did is we identified that, a long-term care expense could be a big disaster in their situation. And the good news is they're young, so they have choices about, decisions that they can make to offset that in case something happens in the future. But when we stress test the plan, we can look at the impact of what if a market crash happens right after you retire, or Social Security does what they say they're going to do and they reduce benefits by 20% in 10 years, or what if tax rates go up? And then by looking at these areas, what it helps you do is it helps you really try to maximize your retirement savings. And it gives you either peace of mind that that in the location that you want to be is something that is possible and can be, a strategy that you can incorporate. Or if not, then you can start talking about, again, things like maybe visiting for 2 years, doing the Airbnbs, delaying taking Social Security to optimize it is maybe a better plan. But those are all the different types of things that, again, we can do within that retirement team action plan. And we'd love to put it together for you.
And again, all it takes to get started is a phone call, 419-794-3030. It really does speak to the nature of having that plan, put together as soon as possible because, maybe there are steps that need to be taken, but the sooner you find out what they are, the sooner you can take those steps to really increase your probability. And then, not to say that the plan can't change down the line. Maybe you decide you do want to move after all, or you want to stay, right where you are, being able to go back and reconsult the plan and see how that changes things. But it all begins, once again, with that phone call, 419-794-3030, or setting up a time on the website as well, including finding out how to attend one of the upcoming events that they've got at arhq.com. Finally, The Federal Reserve began to cut interest rates this past week, and it looks like they're just getting started. Wealth manager Mark Newton tells Fox Business if the Fed's future cuts are more drastic, the market, well, could feel a correction.
Historically, it's been 2001, 2007 when the Fed cuts more than 25 basis points, and it's been problematic to stocks. So, yeah, there is about 200 basis points of cuts right now priced in between now and next July, which is an extraordinary amount right now. But we are in election year, of course, and you really want to be cognizant of that. The market's very ready for this of now. The Fed does not want to disappoint the market.
So, a bit of uncertainty possibly ahead. Is now a good time to take any profits and maybe rebalance for whatever may come down the line?
Well, if you go back to our economic summit that we did in the beginning of this year, we had talked about what some of the top strategists had projected for the market during an election year. And, the good news was a majority of economists had predicted the market, and strategists felt that the market was going to be positive in an election year, which is what we talked about.
Mm-hmm.
That's exactly what happened. Yeah. I would think, from here to the actual election time, I would expect continued volatility overall in the market. September has historically not been very favorable in the market. We've seen more volatility now. And, when you're looking at, taking profits and rebalancing in the portfolio because of the uncertainty ahead, the first thing that I would say is there's going to always be uncertainty when it comes to investing. There's always going to be people that are predicting a correction is coming. There's always going to be people that are predicting that the markets are going to rally. If you want to know what the retirement guys in America's Retirement Headquarters predictions are for the future and how to get ready to not only survive and thrive going through this time frame, what I would tell you to do is go over to our website, arhq.com, click on the events tab, and come out to one of the two events. So number one, we have coming up at Mansey's is we're going to be talking about the 5 threats and opportunities facing retirees. And the second event that we have coming up is going to be our semi-annual economic update. At the economic update, what we're going to do is we're going to have a panel discussion where we're going to be talking about, the state of the economy. We're going to be looking at where the numbers are. And we're going to be talking about strategies to move forward. So 2 great events that you can participate in. Going back and looking at, should I rebalance my portfolio before year end? I would say that one is, when is the last time you rebalanced your portfolio? In the model portfolios that we have, that we build out, what we would normally do is we would normally rebalance a portfolio about twice a year. So twice a year can be a good time where you're selling off some of your winners and you're rebalancing into ones that are a little cheaper that you feel that there's still good opportunities with. You also could look to rebalance your portfolio when markets exceed one level or another. If we go back and we look at the thought process, if your goal was that the market was going to go up 5 or 10% this year, and, if the market's up 15 or 20%, that would tell you that markets on the equity size, maybe raced up a little bit quicker. So we've got, 2023 was a good year in the stock market. We've got 2024 was a good year in the stock market. Maybe you've just said it and forget it and haven't looked at things for a while. You could be the type of individual that would, benefit from a rebalance because you haven't done it in a little while. The other area is taking a look at, what does that present an opportunity? So if you're going to go maybe from equities, you move more money into bonds. And as we talked about in an earlier segment with the Federal Reserve looking and lowering interest rates, that now makes bonds a little bit more attractive. So there was a period of time where bonds were kind of beat down in the price because of the interest rate fluctuation that we have. And rebalancing allows you to take maybe some money off of the equities, move money over into the bond category, sticking with that. And then it comes down to, your measurement of risk and determining what you feel comfortable with. Short term, I'll be the first one to tell you that I'm willing to give you my opinion about what the market's going to do, but the market doesn't care what my opinion is. I just know that the market is at an all-time high. So the things that we're talking about with our clients is, what is your downside exit strategy? Have you run the fire safety drill with your portfolio? And if you're not sure what to do, again, in that retirement team action plan, one of the things that we're going to do is we're going to run a stress test on your investment portfolio. We're going to look, for opportunities on how maybe we can drive it up a little bit. Another good example, we talked about John and Mary, and, again, John's getting ready to retire at the end of this year, and Mary is also already a stay-at-home mom. And with their plan, looking at it, we put their investments in our software, and we're able to take a look at what their overall risk number is. We measure risk in terms of 0 to 100. And they were, about a 60 level risk. And so what that means is that, John and Mary are moderate to moderate growth oriented type of investors. In stress testing their plan, what we could see is that if we go through another 2008 type of environment, what the portfolio results could look like in a major sell-off. In John's situation, he had the majority of his money invested in his 401k in a target date fund. He also owned a variable annuity that had a moderate allocation inside of it. Both of those 401ks and his annuity were subject to stock and market risk. What we were able to do is we were able to take and talk to him about, with the market at an all-time record high, maybe you take some of those assets and reposition them now, taking advantage of where some of the higher rates are in non-market type risk investments. And then explaining to him what the methodology was or the philosophy of what he owns. He didn't really have a good understanding of what the methodology was of his investment in the annuity or inside of his 401k. But when you know the process, or the process that, say, we go through in explaining to our clients the Retirement Guys formula on how we pick investments, what it can do is it can help you avoid making those emotional decisions of fear and greed, and instead put you in a situation where you could take advantage of opportunities. In this case, maybe taking advantage of opportunities to lock in some profits and rebalance before, the market sells off. That allows you to take advantage of where some of the assets that are a little bit lower in price have maybe a little bit more potential for shorter term price appreciation. So if you're laying there at night and you're, within 5 years of retirement, this is where it really starts to get crucial. If you have retirement coming up in 5 years, or you've retired in the last 5 years, the market and what could happen could have a much bigger impact. If you're not confident in your plan, that retirement team action plan will allow us to show you mathematically what's at risk. And you want to know what's at risk before something bad happens, because waiting until after something bad happens and then reacting to that can be a costly mistake. So again, if you have more than $250,000 in retirement savings build up and you want to get that retirement team action plan, all you have to do is reach out to us. We'd be happy to put that together for you.
And all you need to do to get started is reach out. The number 419-794-3030. Once again, 419-794-3030. Threats and opportunities is a very common theme in what Nolan and the team at America's Retirement Headquarters talk about, being able to find where those opportunities lie in times that more often than not will give people a little bit of emotional uncertainty. It was a theme in one of their classes they had earlier this year. It's going to be a topic that comes up at the Economic Summit in October. If you'd like to attend that, they invite you to go to arhq.com, click on the events tab for more information, including how to go and reserve your seat. Or if you can't make that, you can also just skip the line again. Take advantage of this retirement team action plan offer right now by giving a call, 419-794-3030. Back in 1978, Ted Benna invented the 401k. Fast forward, now he's not so happy with the way things have turned out. The original plan was to have the employer cover the administrative fees, but that has not been what's happening. Instead of absorbing those fees, employers and providers are charging higher fees, some as high as 2.75%. Look, there are some fees you could do things about, and there are some fees that you just can't. You just kind of have to grin and bear it. Is this something that you help people navigate to figure out what can and can't be avoided?
Yeah, I mean, when you look at it, there's controllable items when it comes to investing, and there's uncontrollable items when it comes to investing. And I think the controllable items would be like the amount of income or yield that's produced out of a portfolio. So you can invest into things, that pay a fixed amount of income. You can invest into companies that pay dividends. And, although the share price may fluctuate, dividends tend to be more of a consistent part of a portfolio controllable item. The other controllable item that you have in a portfolio is fees and expenses. And by investment selection process, that is one of the ways that you can try to minimize some of the fees and expenses. But for most people, I'm talking again to employees here. For most people, the employees, they have little to no control over the different investment choices that are offered within the company 401k. So sometimes they feel, and they can be a little bit stuck with inside of the fees and expenses that they have. But I'm going to give you some pointers, and I've got some options for you. So number one, what I want you to do is I want you to understand the different type of fees. So the different types of fees that I would say you pay attention to would be the probably biggest one would be fund expense ratios.
Okay.
So the investment that you pick, if they have a laundry list of 25, 30, or 40 different choices, those are your fund choices. And those funds have underlying fund expenses. And you can request those fund expenses through your employer to take a look at them. And or a lot of times you can go onto a website like morningstar.com or go on the internet and do the research. The second one you take a look at is administrative fees. The administrative fees that can add up. I had ran into a lady not that long ago, and she had worked at a couple different places over the time. And, within each of her plans, she had different administrative fees. So, consolidating it down to her current employer or a tax-deferred IRA could be a way to help reduce or eliminate some of those administrative fees that she has. Investment management. Some of the plans that are out there allow you to opt in for utilizing a third party for the investment management part of the portfolio. That's taking more of an active approach. And within that, you might have investment management fees. That could be a flat fee that's quoted for giving you guidance on picking those choices, and or it could be a percentage of the assets account value that they charge for those investment management fees. Service fees. So if you take a distribution or you take a loan, knowing what those different service fees are. And then some of the plans implement short-term trading fees. So years ago, they were trying to, get people away from going into their 401k and, buying and selling on a short-term basis when day trading was pretty popular. And so some of these plans, they'll implement these short-term trading fees, which can really, eat away into your total return if you're actively trading and you're subject to those short-term trading fees. So what you can consider is a couple different things. When you're looking at it, and if you're limited to just the choices within the plans, going back to that fund expense ratio, you could look at choosing a funds that are more, say, index-based investments. Within an index-based approach, you're going to get exposure to, a lot of the investments of that underlying index. Some of the most common that you hear are the S&P 500 index or the NASDAQ index. And so although you're not investing directly into the S&P or the NASDAQ, you're getting exposure to the stocks that are in that portfolio. And because of the fact that it's a passive approach, what you're going to do is you're going to have lower expenses than traditionally what you would have in a more active approach. So a more active approach is going to be one of the common mutual fund names that are out there, and then they're actively managing, buying, and selling. The other thing that you could do is if you're, most of the time, if you have an old 401k, so if you've changed employers and you've left your old 401k, you have choices, right? Mm-hmm. So you could leave it where it is if it meets a certain balance requirement. You could take and cash out the 401k, which would be a taxable event, generally something I recommend against. You could take the 401k and roll it over to your new company-sponsored 401k, or you could move it to a self-directed IRA. So for those of you that have an old 401k, and then also for those of you that are after the age 59 and a half, a lot of the plans have an age-based in-service rollover option once you reach 59 and a half. Now, I don't know where they picked age 59 and a half, but apparently at age 59 and a half, that's when you're responsible enough to, I guess, figure out what to do with your money, right?
Yeah, I guess so.
59 and a half, you're a grown-up with your money. But at 59 and a half, you could consider this in-service transfer to a self-directed account. So if you moved money to a self-directed account, and let's say for your safe part of the portfolio that you had, wanted to put it in some of these higher interest rate bank CDs that we have. You could pick and lock in a higher fixed rate while rates are dropping before they drop, getting something inside of there. Most bank CDs, a lot of fixed annuities have no fees and expenses associated with them. So you're going to get rid of those fund expense ratios in that example. You're not going to have those management fees. You could have index funds. So I had met with a friend of mine the other day, and he brought in his new 401k statement. They changed providers, and within his plan, I don't think he had very good choices. I think he was very limited on what his choices were. But if that money was in a self-directed IRA account, he would have the ability where he could purchase index funds, or quite frankly, he could purchase any investment that he wanted and not have the higher fund expense ratios. And, I'm not saying that funds are all bad by any means. I think there's some good funds that are out there, but you've got to be making sure that you're getting more value in the long term than what the cost is. And then last is inside of a self-directed account, individual stocks is another option as well. So if you want to look at ways to reduce your fees in your 401ks, if you want to look at, is your portfolio optimized the way that it could be, and you have an old 401k and or you're over the age of 59 and a half, let's talk. Because again, in that retirement team action plan, the M stands for money management. We're going to look at going in, and we can help analyze what your expenses are. Instead of you trying to figure it all out on your own, we can cut right to the chase and show you what your fees and expenses are, and then talk to you about comparable alternatives to see if there are ways to lower cost. In addition to that, we're also going to talk to you about what your current risk level is and show you, is your portfolio constructed and optimized to try to achieve the highest potential return for the level of risk that you're willing to take. So if fees are something that is an area that's you want to revisit, remember it's a controllable item. Let's take a look at reducing fees in your 401k. And the first step and the easiest step is just reaching out to us and setting up a time to make that happen.
419-794-3030 is how you go about doing that, setting up that time. It's not to say that all fees are bad, but you don't know the value that you're getting if you don't fully understand what you're paying. And that is part of what the team at America's Retirement Headquarters does. So again, to get started, set up, and if there are better ways to make your money work more efficiently for you, they'll show you what that is as well. 419-794-3030 or the website, arhq.com. Costco shoppers are upset over the warehouse's chain's first membership price increase in 7 years. They might be soothed by a new feature on its mobile app. Hey, first of all, hot dog's still at $1.50. Don't worry about that. But the feature lets you search the inventory of your local Costco so you don't have to drive there to find out if the item is available or not. Pretty convenient. Does hiring the Retirement Guys Formula, America's Medicare Associates, also make financial planning more convenient, Nolan? And if so, in what ways?
Well, I really do feel, and I'm biased, that a financial advisor can make planning more convenient. And if I think about it, there's so many different specialties that you have when you're in your working years and your career path. When I look at it, our area that we focus on here at America's Retirement Headquarters is specifically planning for getting you to and through retirement. And when we look at it, one of the advantages that you have of working with a financial advisor or professional is you get those personalized financial strategies. For every single person that comes into our office, we go through a planning process. And the first part of that is figuring out what their goals and objectives are. And then what we do is we take all of that factual information, their 401k, their taxes, their insurances, and we do a deep dive analysis, and we provide them a personalized 2-page printout. It's called our Retirement Team Action Plan. And within the Retirement Team Action Plan, it's a way to help them understand their unique financial situation, goals, and risk tolerances. It's used to create that customized plan tailored to specifics of their needs, and helping them, figure out what could be the best approach on putting that together. To me, it's oftentimes acting as a client's personal chief financial officer. So just like any corporation has a CFO, that's really what, a financial professional can do when they're taking that holistic approach. I would also say that it's a time-saving convenience. We can take a lot of the heavy lifting, handling of the details of investment management, coordinating things with the accountant or CPA through tax planning, doing that financial analysis, coordinating the estate plans with the estate planning attorney. That is really how it kind of all works together. Even with Scott, when we're looking at the health insurance or what they offer through America's Medicare Associates, Medicare options, the supplement, the advantage, understanding what the Inflation Reduction Act changes are for 2025. I looked at the list of those changes that are coming up. It makes it difficult to try to navigate all of that. And of course, when you're bombarded, from conflicting information on the internet, that definitely can be a time saver of working with a financial professional. And it goes into that, again, the team approach. So when we talk about team, we're talking about taxes, estate planning, asset protection, and money management. But more so, we're also talking about the holistic approach that we take here at America's Retirement Headquarters, getting all of those people together on the same side of the table. We look at long-term care planning, setting realistic objectives to develop a plan to achieve something that, can be 20, 25, 30 years of a retirement, not just looking at what the markets are going to do today or tomorrow, but also doing those regular reviews and adjustments of your plan along the way, helping to ensure that it's aligned with your custom circumstances, your life changes that happen. I think, we can offer an objective perspective. I know we're all a little nervous about the upcoming election, and that's okay. I mean, that's a human emotion, but emotional decision-making process can be very poor when it comes to making financial choices, especially during times of market volatility. An advisor can provide an approach based upon logic, based upon history, and based upon experience. I've been in this industry for over 30 years now. We've been through the 2008, we've been through COVID, we've been through the, 3 years in a row of 2000. That can help you. And I think advisors earn their paycheck in challenging times to help somebody get through and stick with the plan. Mm-hmm. You can have access to resources and tools. We have software that we're able to do the portfolio analysis. We're able to have software that helps us identify, what could be the true value. And then we build that all together with educational values, things like our economic summit and or our, retirement planning events that we have coming up. So if you're looking at it and you're thinking about, I need a second opinion, I'd like to, talk with a financial advisor, and maybe it's the first time, maybe you're in a 401k getting ready to retire. The first step that you can do is come out to one of our upcoming events. We have an event coming up at Fancy's. We're going to talk about the 5 threats and opportunities facing retirees. We also have one of our most popular events of the year, which is our Economic Summit. It's coming up at the Hilton Garden Inn. Going to be sharing a fireside chat about the outlook of the markets moving forward, helping explain strategies to not only help you survive and thrive, or if you've listened to us and you're like, hey, I just want to jump to the front of the line, come in. We'll put together a complimentary retirement team action plan for you and show you how this can make working with an advisor more convenient in your situation.
Just by listening to the show, you're showing that you're taking your retirement seriously, the planning process seriously. The next step, of course, is having the team put pen to paper for you, put together that team action plan, that retirement team action plan. Real easy to do. 419-794-3030 is the phone number to get started. Nolan mentioned those events coming up. You can go to arhq.com, click on the events tab there to go and reserve your seat, continue that education in the more informal setting, or you can set up a time to speak with them as well right there on the website, and that is arhq.com. Want to thank you, as always, for joining us here on America's Retirement Headquarters. It is the home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. Please have a great week ahead of you. Stay safe out there. Nolan, appreciate you taking the time to spend with the listeners and viewers. And as we wrap up here, I want to leave you with the final word.
Yeah, just enjoy the beautiful weather, enjoy your week, and remember, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys Formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.